Well, we closed at a really important level, this 2350 to 2400 level, since that was the intraday and closing low back in December 2018. So from that perspective, it'll be really important to hold. I think the key is obviously whether this selling here transfers over further to the Asian markets and certainly Europe tomorrow. I think the key is really getting past the next 6 weeks. I think the more you hear about shutdowns, while that may scare people from an economic perspective, it is what is needed in order to get over the hump in terms of containing this virus.
Mike, what will you be watching? Is there a headline or a certain data point that you're waiting for?
I don't think that's the immediate thing that we're waiting for necessarily, Sarah. I don't think that that's necessarily going to be quick enough to determine whether this market makes its next move further to the downside or not. I think the market has been ranging so widely to the downside, not because it is in a precise way sniffing out exactly what's going to be going on with the economy, but because people have no idea and they'd rather sell first and get liquid and go to cash. Maybe we have to get down to a level where it reaches the buying interest of people who admittedly have no idea where this is going, but simply believe the market's gone down enough, as Howard Marks was telling you earlier. So I don't know where that is. We can talk about the December 2018 low. It seems too close for us not to touch it, but everything is in there in terms of the makings of one of these reflex moves higher, except for the sense that we have any real grasp on what the economy is going to look like a few weeks out. We don't even have the numbers in terms of testing volumes for us to necessarily feel like we're tracking a metric that we can then anticipate when it's going to turn. So all this stuff leaves everybody in the dark.
Well, to Mike's point, another way of saying it is that the selling could just exhaust itself in the short term, that it can just sort of run out, that maybe it's not, as you said, the number of test kits or some sort of metric that we're waiting for. It can just, on a short-term basis, just exhaust itself. And that leads us to a bounce of some sort, and then we can see how the news flow comes after that.
Well, Peter, one thing I wanted to ask you about, I mean, obviously the move in stocks has been stunning. What are you seeing in the bond market right now? What are treasuries telling you, and why is gold falling?
Well, gold is falling in a sort of a liquidation type situation where everyone is just selling whatever they can. You know, from a fundamental standpoint, with the Fed announcing $700 billion of QE and cutting rates back to zero, it's hugely bullish for gold and silver as well, but it's just getting up in the crosshairs of a complete liquidation. I think in the credit markets, there's obviously balance sheet worries, and that's where the excess was over the past 10 years relative to cash flows, relative to the overall economy. And now that you have worries about cash flows, can we service that debt? So that then gets to, well, did what the Fed announce, able to address that? And I don't think it is, because I don't think the tools that they've used will. I think we need banks to step up to be able to buy time for companies that need capital. I think the Fed does need to get active in the commercial paper market, because that's where we're seeing a lot of dislocations. And the commercial paper market, just as we saw in 2008, is a huge, crucial short-term funding vehicle.